The following BLTV program is brought to you by O'Flaherty Law. Please enjoy.
Hey everybody, my name is Bryan McDonald from OnPurpose Growth, and thanks for joining the Seize Your Business podcast. Today we have Bill Hardesty and Dave Richter from Arboretum Wealth and Trust Management, and today we're going to be talking about pulling back the curtain of fees in the wealth management investment space. So I thank you guys for being on today, and I appreciate it.
Thank you for having us.
So we were talking a little bit before, and we were talking about the problems the challenges people run into in the space that most people invest in, mutual funds, and I think that's is that a good area to start for talking about fees in the marketplace?
Absolutely.
Okay.
That's kind of near and dear to our hearts because we endeavor always to look for the best investment choices for the people that we serve, and in doing so, we've learned that the investment marketplace in mutual funds is wrought with fees, oftentimes hidden fees, and because those hidden fees are not so evident to investors, they're often left out of the discussion when it comes to hiring someone for investment advice, picking a trustee who's responsible to manage assets for sometimes children yet to be born, the disabled, whoever you serve as who is your beneficiary, needs to have the best service possible at the best price possible with the best performance. And with the prudent investor rule requiring us to be impartial and act in the best interest of those we serve, we think it's important that what we've learned is kind of spread out to the marketplace, to the customers.
So are all fees equal in mutual funds, or is there a difference?
There's, to break it down into two major categories, there are actively managed funds, both mutual funds, ETFs, any sort of collective investment like that, and there are passively managed funds. Typically you'll think of them as index funds. And that broad delineation really sets two layers of fees. So those actively managed funds, fees have come down, but they're still, let's call it in that 50 to 125 basis point range as an average. Whereas ETFs, passively managed funds, will typically be about 1/10 of that. So it's a 0.5%. It doesn't sound like a whole lot of money, but if you take that 0.5% and then compound it over, let's call it a career of 30 years.
Yeah, right.
And you end up with about 30% more money off that 0.5% each year. So it becomes a real big number over a long period of time. So what we've done is, are you getting what you're paying for? Are you getting extra return for the extra fees? And there have been studies put out by S&P Dow Jones Index that show that about 80% each year, about 80% of all those actively managed funds underperform the index. So you're paying more and getting less.
So why would somebody pay for an actively managed fund?
Because they tell great stories.
Oh, really? Okay.
The people like to think that there's a lot of smart guys in the investment business,
right? And
they're always trying to outdo each other, and everyone can tell a great story. I think this is going to work. I think that's going to work. And sometimes for short periods of time, they will outperform. Typically, maybe they'll hit like a 3-year hotspot, and they'll hear, these guys have a Morningstar like 5-star rating. Well, what happens is that performance is not persistent. So if you think about the business cycle in the U.S., you have call it a 5 to 10 year business cycle.
Yeah, right. Yeah.
So if someone's had a great 3 or 4 or 5 year run, and their system, their plan is working, and everything is going great, that's about the time when the cycle's going to turn and they're going to underperform. So if you look at those 3, 5, 10, 15 year ranges consistently across equities, fixed income, international, about 80 to 85% of those guys underperform across those time frames.
So so that's actively managed. How does the passive one work then?
So the passively managed one is, and I'm sure most people have heard of the S&P 500. It's the 500 largest companies in the U.S. They buy that lot of 500 companies, based upon the size of the company, and basically they hold it. So they don't try to outsmart the market by saying, well, I think this is undervalued and I think this is overvalued. They just buy and hold. And there's a couple advantages of that. One, obviously it's a lot cheaper to run. You don't need to pay a bunch of analysts to try and find those things. but also there's less turnover. So that means there's less, it's much more tax efficient. You're not paying capital gains and all these things.
Okay.
You're also not paying for the trading, for the commissions within the fund. And that's some of those hidden fees Bill was talking about. Was there's the management fee, like, you know, that's 65 or 100 basis points, whatever that is. But there's also costs to run the fund. There's accounting costs. There are, like I said, trading costs, and all those things build up over time. And again, those little differences that you can squeeze out make a big difference over time.
Oh yeah, I mean, 30% more money.
Yeah.
For something that performs with the market versus somebody you're paying a lot of money to and saying I can beat it. And what you're saying, I hear you saying, is they're not beating the market, right?
Right. That's exactly the case.
So I mean, is there something going on or in the marketplace that's helping contain this, or do something about it? Because this doesn't sound, this is not a good story to me.
Well, we have the Department of Labor looking at those who advise on retirement plans. For years, they had a suitability standard that professionals who provide advice or build portfolios had to use investments that were suitable to the goal of the client.
Okay.
That's changing as the DOL has identified the need for full disclosure of the fees involved in that investment and requiring those providing that advice to act in the best interest of those they're serving, whether it's a plan participant for a 401k plan or whether it's an individual's IRA. And there's a reason for that, because many investors will take their money, they give it to someone to manage. They expect a certain amount of expertise. And in doing so, that person may have a vested interest in the investment choices you make in the form of 12B1 fees. It's a fee that comes along for selling or promoting the mutual fund. So there's an incentive there. Maybe the advisor works for a particular company that has funds that are proprietary, that are actually their own company's funds, or they have an inventory of certain bonds that they need to push. Well, in the case of a mutual fund, now all of those fees must be disclosed to either the participant or the ultimate consumer. There's been a lot of pushback by the industry to not have to be fiduciaries. And at Arboretum Wealth and Trust Management, we are all fiduciaries. It's a house of fiduciaries.
Okay.
So this seems strange to us because we have made an effort to strip all of those fees, where possible, out of our investment strategies, because we've learned that the stories are great, but the reality is you don't get what you pay for with managed investments. And to put it even in greater perspective, you have someone who, say, inherits $50,000 and has no idea how to invest. They're going to go to a professional. In order for that professional to manage those assets, they may say, well, you can pay me 100 basis points or 1% of the assets under management to manage your assets. And you say, okay, well, the inquiry usually stops there.
Okay.
I'm paying my professional 1% to manage these assets. Well, the choices that they make could in turn cost them another 1.5%, 1.75% in fees that they don't even recognize are there. Well, that's erosion of return. So now not only does the person who put together this portfolio have to perform at a higher level just to break even, those managers within the funds that they've chosen to use for you have to perform at extraordinarily high levels just to get back to even. And statistics, as Dave has said, that are out there, they're easily found, do not support that you can do that consistently over time. So again, you think you're paying for an expertise that is going to result in greater returns, and in fact they erode your returns over time. I mean, John Bogle, who was the founder of Vanguard, has said we're paying people to beat the market when they aren't doing it. And when you think about that, that doesn't make sense. And we have premised everything we do on that exact idea.
So this is his comment.
This is his comments to the market.
To the market.
Over and over again.
That's interesting.
In 2016, investors pulled out $200 billion from actively managed. Those are the expensive actively managed funds. While passive funds took in $150 billion of that. The investors are starting to become more aware of these fees. The DOL, if anyone pays attention to that, the DOL rule has gotten those people who will listen to understand, wait a minute, even in my 401k I have to pay attention to this? Yes, because the menu of choices that you have in your 401k, more likely than not, are going to contain very expensive mutual funds. And by expensive, I mean they cost a lot to own.
Right.
So you need to look at your own mutual fund. If you have an IRA that you had rolled over, take a look at it. Even if it's a custody account where you're not paying for advice, you've picked from, say, a menu that maybe the advisor who opened the account for you showed you. Mm-hmm. Someone's getting paid on those. If they were index funds, there's nothing paid out for selling those. There's no incentive to the person picking those investments for you to do so. So that's what the DOL is trying to get in retirement funds. They're trying to get full disclosure of what we believe as fiduciaries at Arboretum Wealth and Trust Management believe should be disclosed anyway.
So fiduciaries are already doing it.
Fiduciaries are already doing it.
And if you're not, I guess what I'm hearing you is if you say, what is your fee to manage these funds? And they say, whatever, 1%, 2%. The next question to ask is, what are the other fees involved in this?
Exactly. What do these investments cost me? And actually, to clarify, I don't think other fiduciaries are doing this because for clarification, because they don't have to. In the case of a trustee in Illinois, the Trust and Trustees Act allows a trustee who invests to retain 12B1 fees, those fees that are out there for promotion and selling the mutual funds. It's perfectly allowable. But should you? I mean, there's an argument to be made there that if you're not disclosing or otherwise adjusting your fee to the reasonableness standard as a fiduciary requires, you're not doing the right thing. And there's an argument to be when you sit down with your fiduciary. So when you're choosing a trustee or a guardian for, say, a disabled adult, there's money there to be managed, and that management should be scrutinized because the process is just as important, if not more important, than the performance.
Yeah, got it. Makes 100%. Well, listen, I appreciate your guys' time for being on. You obviously know exactly what you're talking about and looking out for the best interests of people. So if anybody's interested in learning more about what Dave and Bill do, you can reach out to them with the information on the video, or if you're online, you can actually pull that information off next to the video or the podcast. So thanks again for listening and watching in. I'm Bryan McDonald from OnPurpose Growth, and appreciate you tuning in to Seize Your Business podcast. Take care.
Thanks for watching our video. If you have any questions, feel free to comment below. Click the subscribe button for new videos every week and download and review us on iTunes. Visit learn-about-law.com for other legal-related articles and videos. Visit our business podcast and video blog, seizeyourbusiness.com, and visit makingrealestatefun.com for real estate videos and podcasts. Call us at 630-324-6666 for a free consultation. Thanks for watching.